Hello ladies and gentlemen, my name is Matt Brown. I am the US Equities and Options Analyst here at Halifax Investment Services, and we're quite excited to bring you the butterfly effect trading strategy. This is a strategy we've been running for quite some time. We've run it with different variations. Previously we've been using the Iron Condor strategy, but the approach, the setup is exactly the same, and we've been able to work out a better approach to the strategy to benefit from certain market events. Before I go too far into what the strategy is and start to describe what we're looking for with this particular approach, I'd like to just describe a few things to help us set up where our mindset is with the butterfly effect. Now, in chaos theory, the butterfly effect is a term used to describe how small changes to a seemingly unrelated thing or condition can affect large, complex systems. Now, this phrase refers to the idea that a butterfly's wings might create tiny changes in the atmosphere that may ultimately alter the path of a tornado, or delay or accelerate, even prevent the occurrence of a tornado in another location. Now, there's been movies that have been made about this premise. It's called the butterfly effect, where by going back in time, of course is a science fiction type movie, but going back in time, changing one event has a major occurrence down the track. Now, the butterfly spread strategy is a neutral outlook where both the bull and bear spread are combined. These positions have risk that is limited to the amount of capital invested into the trade, while returns are capped and achieved with the position expiring with the share price at the sold strike level. We've named our approach to using the butterfly spread strategy the butterfly effect due to the connection of a specific event and the causal reaction that occurs following the passing of this event. As we cannot predict what a share price will do once these specific events occur, we can identify the common occurrence of specific conditions that change, such as time decay and changes in implied volatility. So why do we use the butterfly spread strategy? Now, the traditional method of using this strategy is to implement it when the trader expects the share price to remain within a certain price range, closing at or as near to the sold leg of this strategy on expiration of the option contracts. Now, the probability of getting this absolutely correct, that is, choosing what price the underlying share price will be trading at on a set date in the future, is an exceptionally low probability situation. In fact, you'd have to be Nostradamus to consistently get that correct. Hence, it's a strategy that is more suited for an experienced type of trader. However, what we have identified is that leading into the event of a company's earnings announcement, the implied volatility increases. That is, the uncertainty as to what the company will report for its earnings and how the stock price will react starts to have an effect on option pricing. Now, once the event occurs, the uncertainty dissipates. Hence, implied volatility decreases. And for a lot of the examples that we're looking at, the implied volatility decreases quite sharply. So by identifying these stocks that have high implied volatility, there's a strong probability that once the event occurs, the IV will decrease no matter how the share price reacts. That is, whether it goes up, down, or sideways. The value of the butterfly position will improve with a decrease in implied volatility, and that's with all other factors remaining equal. Now, the key to how we manage the butterfly effect strategy is that we're not attempting to make the maximum potential gain by having that stock price trading at an exact level on expiry of the options. Our management approach is to establish a profit-taking level, and this is usually set at a minimum of 50% of the expected maximum return. Therefore, we'll be closing the position as early as possible following the earnings announcement. So once the earnings announcement occurs, the implied volatility drops. What we're looking to do is exit that position as soon as possible. We don't want to be running that all the way through to expiry, because that additional time, whilst time decay is working in our favour, the stock price could do anything. It could rally further, it could decline further, but it may not actually be trading in and around the sold strike. So rather than implementing the butterfly spread strategy and predicting that the share price will be trading at a set price on a set date in the future, the butterfly effect approach has been developed from experience in trading stocks around their earnings report, and with an understanding of advanced option pricing techniques. As with all strategies, the setup of a position is not the only important factor. Money management is exceptionally important, and hence we have stringent rules to take profit early and to cut losses where possible. In the end, each trade should only be adopted if the trader is willing to risk the amount of capital on the trade. The maximum loss for each one of our butterfly positions is 100%. That is, the amount of capital you put down on the trade is how much we're willing to risk in the position. The risk of the earnings announcement is that the share price gaps exceptionally high or low after the event. Now, this normally occurs if the company provides results that exceed or disappoint, surprising the market and missing expectations. Should the share price gap too far, the maximum loss is potentially achieved. Hence, the selection of the position, that is the strike levels, need to be considered, and what would be considered an acceptable level for the share price to gap. In most examples, we'll be choosing bought legs that are approximately, if not greater than, 10% from the sold strike level. So let's take a look at our more recent quarterly results for the butterfly effect strategy. In this table, I've listed all the trades that we have done for the 2 months between April and May. Starting with FFIV, we did have our first trade for this last quarter at a 15% loss. Now, all of these returns are represented as gross percentage figures, not including brokerage fees. The larger your position size, the smaller the brokerage is as a percentage of your position, and that then has an effect on the net return that you will make. Now, risk level 1 clients have all been profitable after brokerage through this period. Now, of course, we do see trades such as Lululemon, second from the bottom, where we've made a 100% loss. And that is an example where the stock price gapped 15% from where the sold strike was, which is the $45 strike in that example. Now, once it's gapped that far, then there wasn't an ability to recover from the position. So we only put down on the trade what we're willing to risk. These butterfly positions are usually held for 1 to 2 weeks, as you can note with all of the positions that were traded through the last quarter. For example, FFIV was ended on the 22nd of April and exited literally a week later on the 29th of April, and so forth through all the trades. Let's now take a look at a few trade examples of some of these butterflies that we have traded. Here we can see FFIV just working from the top of our previous table down through the top 6 trades there. We entered FFIV 2 days before the earnings event and then exited the trade 3 days later. Now, this one resulted in a 15% gross loss on the position, and that is as the share price did start to test the lower range of the butterfly. But what was important about the trade was that we were correct with that assumption that implied volatility declines sharply once that earnings announcement has occurred. The share price moved probably a little bit quicker or a little bit further than anticipated, especially as we had a strong support base in through here at $102.50. So the expectation was that FFIV would maintain that support base. It tested down below there, and that was the reason for exiting the position at that point in time. With Facebook, we entered the position almost a week ahead of the earnings announcement and closed that 4 days after the event. Implied volatility had already started to decline. However, we still had a sharp decrease in implied volatility on the earnings event, and whilst it's only a mild 7% return gross, basically break even as a position, we were able to maintain the trade and not lose the expected risk associated with the position. With Twitter, we entered that position almost 2 weeks ahead of the earnings announcement. We can see here that when we had entered the position, implied volatility was at extreme highs. It had already started declining once we entered the trade. Now, once the earnings event occurred, it declined even further, and we were able to exit this position 2 days after the earnings event at a 65% gross return. With LinkedIn, we entered this position only 3 days before the earnings event. Implied volatility had also started to decline quite sharply prior to us entering this position, yet it was still at very high levels. The earnings event occurred, and the next day we exited the position at a 128% return. Notice how the share price hasn't gapped sharply either direction. What it has done is it gapped up slightly and started to retrace within the next day, and that is when our profit-taking order picked up 128% return on that position. With EXPE, we entered this position almost a week ahead of the earnings event. Once the earnings occurred, implied volatility has dropped quite sharply. We've closed this 2 days after the event for a 52% gross return. With First Solar, we entered this only a few days before the earnings event. The implied volatility had also started to decline, but was still at very high levels. Once the earnings event occurred, we closed it a few days later, basically at break even, but a minus 1.6% gross return. And finally, AMAT, we entered this position virtually the day before the earnings event. The stock price did gap, and it started to push quite high. We're only able to achieve a 19% gross return on this, as the share price had pushed probably a little higher than what we had anticipated it had the potential to achieve. However, the implied volatility had declined quite sharply. That helped offset that strong rise in the underlying share price. The advantages of using the butterfly strategy in this methodology is that we are looking for stocks with high implied volatility. We are looking for option price reaction around a scheduled event, that is the earnings announcement. As with all strategies, there are risks. The risk of this strategy is that the stock price will gap, and it will gap outside of the spread of the butterfly. Now that will typically result in a 100% loss. However, if we have a sharp decline in the implied volatility, we can usually find a price discrepancy where we can minimize that loss of the position. And that is part of our goal as well, in managing the position if the stock price gaps further than anticipated. Now, the butterfly effect strategy does have live trade recommendations that you can receive through the Easy Trade facility, either using the new application that is available or through the online Trade Me, which you can click through from an SMS or from your emails. Now, our recommendation is that you take all trades to follow the model portfolio. Being selective in which positions you do take or don't take could result in a variation of results. Of course, if you're only choosing 1 or 2 trades out of the several trades we may recommend through the earnings season, if we have, for example, 2 lost trades out of 7, we don't know that the 2 trades you take will end up being 2 profitable ones, 2 lost trades, or whether 1 will be profitable and 1 will be a loss. So our recommendation is to take all the trades within the model portfolio. The reason why we do so many trades, so many smaller trades, is for that opportunity to get those larger events. We know that there will be profitable trades and lost trades. We look to manage those lost trades and minimize the risk on those that gap further than we expected. And of course, we look to achieve that 100% return, if possible, off those trades that meet all those expectations. The purpose of the strategy is to exploit those earnings opportunities without having a specific directional view. If you'd like to discuss this strategy and how to manage this strategy with the capital that you have available with our brokers, you can call us on 55 854 200. Alternatively, you can email us on support@australianinvestmenteducation.com.au. I wish you the best of luck with your trading. If you have any questions, you can get in touch with our brokers and they'll walk through what this strategy involves and discuss money management approaches for the capital that you have available. Until next time, happy trading. My name is Matt Brown. I'll speak to you again soon.